Okay. Uh, Good morning. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from the Shoal Lake 40 First Nation and Treaty 3 territory. My name is Neil Harden. I'm chairing today's panel. With me via Zoom are Gail Anderson and Carrie Linklater. The assessor today is Roddy Pontanilla, and the recording secretary is Belen Rojo. To the Zoom participants of the hearing, please note you are placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along in the City of Winnipeg's Border Vision YouTube channel for the hearing process. Once the host admits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application and will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it in the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order to be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they so wish. Once all the evidence about an application is being brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. We'll be hearing items 5 through 9 on their docket today. Ms. Rojo, please affirm the assessors and the applicant's testimony for the first property.
Mr. Assessor, please state your full name.
Roddy Pontanilla.
And you affirm the evidence you're about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Applicant, please state your full name.
Gary Ruffreimer.
And you affirm the evidence you're about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Okay, the first property on the docket today is 1680 Pembina Highway. So, Mr. Pontanilla, you can begin.
Okay, thank you. Am I muted? No, I'm not. So the first file on the docket is file 22-1098. The roll number is 0308-004-0500. The address is 1680 Pembina Highway. The 2023 assessed value has gone out at $1,934,000. So this property was actually labeled as a commercial retail store, although that labeling is a little bit off of what this property is used at. It's used as a retail warehouse. So that was an error that was changed with us of a code, but it is a commercial retail warehouse unit. The actual and effective year built is 1997. The leasable area we have on file is 9,832 square feet. So if I can direct your attention to page 2 of my brief, and I'll just begin my presentation here. I've included an image of the subject's orientation on Pembina from our pad eye view. On page 3, I do have an overhead view of the subject property. On page 4, I do have both a north-facing view and a west-facing view of the subject property. And then on page 5, I do have some images of the subject property as we approach it face on and as we're departing. We have received the request for income and expense mailer information, so we're okay there. And we do have a sale on this subject from 2004 for $726,000. And we don't have any lease information on the subject. So for my comparables, I chose from our portfolio of commercial retail warehouses. So they are bigger spaces that are used in a retail fashion. And I do have rent ranges from $13.55 at the lower end up to $19 at the higher end. So we do have one premise on the income stream. As I mentioned earlier, we have 9,832 square feet at $14.22 a square foot. That does give us a total potential rent of $139,811. We do have model parameters in place for this particular property of 4% vacancy, 3% expense, and $6.50 per square foot for a shortfall, which gives us a net operating income of $127,636. We've then applied a 6.6% cap rate to come up with our assessment of $1,934,000. So if you look at the income value summary on page 9, you can see just a summary of what we had just gone over. And then on page 10, we have our cap rate information, and we have our retail section towards the middle of the diagram there at the box. On page 11, we have our Municipal Assessment Act excerpts. And then on page 12, and taking us to the end of our brief, is the subject's 2020 income and expense mailer. And that's my presentation.
Okay, questions, Mr. Reimer?
Thanks, Mr. Chairman. Mr. Pontanilla, could we initially turn to your page 7, please?
Sure.
So this is the rent comparables. Now we can agree that the reference date for the 2023 assessments is April 1 of 2021, correct?
That's correct.
Okay. And so of your lease comparables there's only 2 that fall within sort of the 2 to 3 year period around the reference date, and that's 2860 Pembina and 810 St. James, correct?
Correct.
Okay. And the rest of them being considerably older, I take it you'd agree with that?
I would agree with that. From the lease information I looked at for these portfolios, it seems like long-term leases seem to be a bit of a norm for these bigger spaces, but it is true that this particular set of comparables has some that are quite older in leases.
Certainly, and that's exactly what I'm suggesting. So in the case of 810 St. James Street, that's I don't know if you're familiar with those properties, but that's the strip of retail warehouse units that are right across from Polo Park Mall. Were you aware of that?
Based on the address, and yeah, I was aware of that.
Okay, so that location right across from the Premier Regional Center in Winnipeg would be a location I'd suggest you that's superior to the subject. Would you agree?
I would agree with that.
Okay. Going to then page 8. So, and I think you've alluded to this, the right actually from the potential rent on through, these are all model driven parameters, correct?
That's correct, all model driven.
Okay. And Mr. Chairman, those are my questions. Thank you.
Okay, Gail, do you have any questions?
My question is in regards to the comparables as well.
Sure.
Were there no additional comparables in the area of Pembina Highway?
Well, again, there were other comparables that I could have looked at, but for this particular brief, I wanted to just include sort of apples to apples. So I wanted to include properties that were used in the same fashion of being a retail warehouse usage. And so from that point of view, I just decided to go with these. But as Mr. Reimer alluded to too, I do have 2860 Pembina Highway there as one of my comparables. And if you look at the rental rate on that, and you look at the rental rate on what the subject is, it seems like it's kind of within the ballpark.
Okay, thank you for that. My other question is in regards to, you mentioned you made a change from retail store to retail warehouse. I'm just wondering what that would, did that trigger any change in assessment, or what does that do?
No. So that was a label. So if you think about it, it was actually like a label that was attached to the roll number. So it's just like a lettering that we put on top, a label, for lack of a better.
Okay, a descriptor.
A descriptor. But if you look at my income, stream, you'll notice that the income stream is labeled as RWC, retail warehouse. So it's using the retail warehouse parameters. And I fixed that this cycle so that going forward, it'll show commercial retail warehouse going forward.
Okay, so when you're generating the assessment using the model,
yep,
that's what I'm wondering. Does it draw on all the data relating to warehouse then, rather than retail?
It would under the income stream. So the label that I was speaking of earlier, that's just the label that we use, but it's the income stream that drives the parameters. So in this scenario, the income stream being used is retail warehouse.
Okay, and when was the last inspection of this property?
That's a good question. I didn't have a chance to myself inspect it, and I'm not sure when the last inspection would be.
Okay, and the last sale was 2004. That was an open market sale?
It looks to be, from what I saw.
Okay, those are all my questions. Thank you.
Okay, Carrie, any questions?
My questions have been asked and answered. Thank you.
Okay, just out of curiosity, and the difference between retail and retail warehouse would be what? A higher retail would have a higher percentage of finished area, and warehouse?
I mean, there's many variables as to what would make the differences. It would use different modeling market data indicators that would then go into the rental rates generating, and then it would actually alter the parameters as well that are applied to the income stream. So it would change the shortfall, it would change the vacancy. It could affect the cap rate. So there's many different ways that the income stream labeling does affect the valuation of the subject. But in this scenario, we are using retail warehouse. So as I alluded to earlier, that labeling that I changed earlier, that was just an incorrect label that wasn't changed from the last cycle.
Yeah, okay. All right, thank you. So Mr. Reimer, you can begin your presentation.
Thanks, Mr. Chairman. On the very last question you've asked, actually, I'd like to have a brief comment on that as well. And pardon me, the retail warehouse properties typically, from my experience, have been properties where it's one of two things. Either it's much more, pardon me, much more just a straight, very low finish retail building. Think of the large retail centers, like the most obvious examples are Home Depots or the Brits, or these very large stores where it's really nominal finish. It's wide open space with just their retail merchandise throughout. Or it can also be some of these locations, and this is more true of the subject, where you've got the true retail area in front, but you've got a larger proportion of the warehouse space. And in the case of Visions, it's for doing the things in their shop with their audio work that they do for vehicles and such. So it's that kind of flavor versus a true retail store, which is typically superior or more advanced retail finish in the actual component that the customers access, with a much smaller component of storage for their inventory in the back and such. So that's primarily the difference. And it does have an impact. Certainly what you're going to hear from me as far as capitalization rate, we've got a couple of retail warehouse sales. And certainly we believe those should be taken have very serious consideration in situations like these, being retail warehouses themselves. So if I could ask the board members then, that this appeal revolves around three issues: the potential rent to be applied, the non-recoverable expense allowance to be applied, and to a lesser extent capitalization rate. So if I could then ask the board to turn to page 13 of our submission. And on page 13, what we've got is a total of 5 comparables. There's 2 on Keniston, 2 on Pembina, and another one on Regent. These are all, as Mr. Pontinia had alluded to, we're both trying to find comparable leases for what's truly comparable space. These are all retail warehouse lease indicators. These are all, and I stress this, there's the pardon me, the third one on Pembina from July of 17, so it's a bit older. But the other four are for retail warehouse premises that were negotiated very near the reference date. Now, I find it interesting at the top end, my comparable number one, and this is in Kenniston Common, which is, I suggest, very superior to the subject. It's also a smaller area, but that's at a net rent, pardon me, a net rent of $16. So that's entirely consistent with the one comparable that the assessors presented this morning with on Pembina at 1554. So at the top end of our range is actually consistent with his comparable that's nearest in time to the reference date. But our other four comparables, we suggest very strongly, again, being the retail warehouse type of comparables, the indicated range for these spaces near the reference date is between 10.25 and $16. The two on Pembina being at $14 and $13.75 respectively. And certainly, again, given the subject, and it's been a number of years, but I've been in the subject, and it's certainly, as I say, there's a sort of a front retail area that's built out for customers, and then there's the warehouse area in the back, and certainly this premise I'd suggest would fall somewhere in the middle of the range, and we have selected, based on these comparables, a market lease rate of $13.75 a square foot. I should note, and Mr. Pontinia had mentioned they didn't have lease information. There is actually a lease between related parties. It's a hold-co-opco situation that's in place, and we didn't pay any reference to that lease or take any reference to that lease as between related parties. We simply defaulted to the market indicators in this case. So we're suggesting a net rental rate of $13.75 a foot. We're applying the 4% vacancy, the 650 shortfall for the we're now stating as non-recoverable expenses, used to be called management. As the board members have all heard frequently in the past, we're suggesting the non-recoverable expense allowance should be maintained at 5% plus the 2% for the other structural allowance. So we're, in our valuation and crucially in our capitalization rate analysis, we have applied the entire 5% allowance for non-recoverables plus the 2% for other. And we're asking the board, for the reasons that we've explained in the past, to do so. So I'll go through that very briefly in a moment, but we are proceeding with initially with the position that those expenses should be at the 5 and 2. And as far as capitalization rate, we've got our capitalization rate study was also filed in support of this submission. There's two RWC, retail warehouse comparables, or transactions, I should say, in that study, and they range between 6.72 and 7.39%. That, again, is based on the application of the full 5% for the non-recoverable expense allowance. Pardon me. If one reduces the expense allowance to 1%, it has the effect of actually increasing the indicated caps to well above 7% for those two. So I'll explain that in a little bit more detail in a minute. Based on the assumption that the 5% is applied, we're actually suggesting a capitalization rate of 6.75% this morning in our valuation. So then turning to page 15, as you can see there at the $13.75 a square foot with 4% vacancy allowance, 650 shortfall, the full 5 and 2 for total non-recoverable expenses, and a 675 cap, we come in at a value of $1,750,000. So then if I might take the board very briefly to the non-recoverable expense allowance study. And I'm going to go through this at a very, very high level because I know we've all heard this many times. So starting at page 2 then, the non-recoverable expense allowance we're suggesting in no uncertain terms has always intended to be an allowance for expenses that are never recovered from tenants, even under triple net lease situations. That was stated very clearly in the city assessor's earlier manuals from the 90s and 2000s, and they state, and this is at the bottom of page 2, even with net leases and competent management, there will still be expenses incurred by the landlord that are non-recoverable. That's our very point, is that these expenses are exactly that. Then turning to page 4, at the bottom of page 4, we believe that the suggestion we're making is certainly consistent with appraisal theory. And in the case studies and appraisal from the Sauder School of Business, pardon me, the bottom of page 4, it says the appraiser should also account for non-recoverable expenses. Most important non-recoverable cost items to be aware of are space marketing costs, which include both tenant inducements and leasing costs, and an allowance for structural and mechanical repairs. Now, in our case, we're not, to be clear, we're not factoring in tenant inducements. We're not suggesting that the expense should be based on tenant inducements. We've specifically set out in our chart some very specific items we're using, and those are leasing commissions, marketing costs, professional fees, and in some limited cases, asset management fees. So the TIs we've included for the board's information, the second column, it has the effect of bumping the indicated expense ratio much higher, but we are not using that as a baseline. We're using the non-recoverable expenses without tenant inducements as the basis of our request. So then I just point out on pages 6 through 9, there's two other, Saskatchewan and Ontario, the municipal or the assessment authority there also talk about the non-recoverable expenses, and they too provide some indication that those are expenses that should, at the end of the day, should be accounted for in the valuation. I'll just point to the top of page 7, where this is from the SAMA guide, the non-recoverable operating expenses typically not recovered from tenants are legal and audit fees, structural repairs, and that's part of the other expense. So that's already captured in that allowance. Advertising and promotion and leasing commissions. That the leasing commissions being the single biggest component of the non-recoverable expenses. So then turning to page, there's a list, by the way, on page 9 of all of the potential non-recoverable expenses that we found in our study. Most of those are not included in our calculations of the stabilized percentages. There is only the fundamentally the 4 items, and this is now on page 10 in the middle: leasing commissions, professional fees, asset management fees, and some, but certainly not all cases, and in fact, very minority of the cases, and advertising marketing. So then going to page 11, there we set out the chart with the analysis, and I should state that the at the chart, it actually states on the yellow first row, the yellow highlighted row there, 3-year average. And in fact, that should be updated because I actually went through and updated all of the statistics, and that's typically now based on a 5 or even 6-year average. As I indicated earlier, there's two columns, I should say. It's the first column, the percent of EGI 3-year average, no TI. That's the column we're focusing on. We did, for the board's information, provide the very same analysis where TIs were included, and as I mentioned, it leads to a much higher indicated expense ratio, but we're not relying on that. We're providing it for information. We are relying on the first column, which has an average of 6.64% and a median of 5.98%. Now, if the board were inclined, notwithstanding the submission and this evidence that's been provided, if the board were inclined to reduce the non-recoverable expenses from 5% to 1%, has been done with by the department, I believe, for this cycle, that then will, by definition, change our capitalization rate request. So now I'm at the bottom of page 12. So there is, as I mentioned, an inverse relationship between this non-recoverable expense allowance and our cap rate analysis, and therefore our cap rate request. As the expense allowance moves down, the capitalization rate, because of the methodology we've employed in our calculating our cap rates based on the transactions, the indicated capitalization rate goes up. And I've provided an example, and it starts at page 13 and it goes through to page 15. So in this example, the assumptions, pardon me, the assumptions for the indicated cap rate for this transaction that I've set out using the assumptions at the top of page 13 are identical in every case, save and except for a reduction in the non-recoverable expense allowance. So in the first scenario on page 13, this is the indicated capitalization rate if the full 5% allowance is applied. And as you can see at the bottom of that page, the indicated cap rate for this transaction would be 7.38%. Then if you reduce on page 14, if you take those very same assumptions, exactly the same, except you reduce the 5% down to 0 for non-recoverable, the indicated capitalization rate, as you can see there, is 7.79%, so substantial difference. And then finally on page 15, if you were to reduce the non-recoverable expenses from 5% to 1%, which is what we've seen the department typically doing this cycle, it has the effect of changing the indicated cap rate to 7.71%. So recall that with the full 5%, the indicated cap rate was 7.38. With the reduction to 1%, the indicated cap rate is 7.71%. So it's about 33 basis points difference. And that's the key, Mr. Chairman, is if the board's inclined to reduce the non-recoverable expense allowance from our submission as we've presented it in our valuation, certainly that's the board's purview and can certainly do that, but then please consider the effect on our capitalization rate. In our capitalization rate study, we've applied a full 5% allowance, and reducing that then by definition means that the capitalization rate indicators for all of the transactions would go up by it's in the range of 29 to 33 points or so. So from our perspective, what we're doing is asking for an increase of 25 basis points, less than what's mathematically indicated, but certainly providing for that difference in the non-recoverable management expense allowance relative to our analysis. So that's the non-recoverable expense. Now, in terms of the retail capitalization rate, we could go briefly to that study.
All right, have it.
Okay, so could I, and I'm going to be very brief. There's a lot of information here about the effects of the pandemic and the difficult retail environment. What I do want to do in the case of in this case this morning is to go to, I'll leave it for the board if they want to read all of the information leading up to the pandemic and such, that they're certainly welcome to do that. But I want to go to page, let me get it here. Okay. Starting at page 16, please. And I find this of particular interest, and I'd certainly request that the board seriously consider this, because as we were moving through the pandemic, Altus actually conducted a survey of the most sophisticated real estate professionals in Canada, and these are the companies like the pension funds, the REITs, very large private owners and brokers. So these are folks in the real estate industry that really will be very, very aware of what's going on, very aware of the trends, and who certainly will have the most the most sophisticated outlook as far as what they believe will be happening as we go through, we're moving through the pandemic as of the reference date. There are actually two surveys conducted. One was in April of 2020, and the other was in November of 2020. And if I go then from that survey, if we go to the bottom of page 18. And so the capitalization rate trend that these investors were expecting as a result of the pandemic, as you can see, pardon me, in the graph at the bottom of the page, this is for top quality retail, and I'm not sure the subject would fit into top quality. It's certainly good quality, and I'm not suggesting it's poor quality, which is a chart I'll show you in a minute on the next page. So I'm placing this property in the retail top quality, notwithstanding that it might be on the very periphery of that categorization. But as you can see here in the November survey, which is the black bars that are shown on that chart. These investors expected between 25 and 50 basis point increase in the capitalization rates for top quality retail assets because of the ongoing effects of the pandemic, with a significant number, and that's around perhaps 13 or 14%, even expecting a 50 to 75 basis point increase. So there was, of course, some that were predicting higher still, about 10% expecting 75 to 100 basis points, which was obviously at the most pessimistic end. There were some that were suggesting cap rates would decrease, but certainly the overwhelming majority were believing that between 25 and 50 basis points or 50 to 75 basis points was the most common sentiment by far of the capitalization rate increases for properties that would be considered top quality retail. Then if you go to page 19, the lower quality, and this is a chart I mentioned earlier, the lower quality expectations were even more gloomy. As you can see there in November, the vast majority, in fact, the overwhelming majority certainly thought that the capitalization rates would be increasing between 25 and 75 basis points if you combine the three black bars there. So it was a very, very pessimistic outlook. Now, the subject being, as I say, sort of on the periphery of the top quality, if anything, leaning towards average or to lower quality, I'd suggest that certainly that would be something that investor would be looking at if they looked at the subject property. And then tying that in, if I might ask the board and Mr. Pontanilla, please, to go to page 24. And this is our capitalization rate. These are our capitalization rate indicators. And I mentioned there were two retail warehouse properties. These are indices 7 and 9. And pardon me, with the inclusion of the 5% non-recoverable expense allowance, the indicated range for those two transactions was between 6.72 and 7.39%. If one reduces the non-recoverable from 5% to 1%, then the indicated range becomes 7.02% to 7.71%. So certainly based on the transaction, these were pre-pandemic, and so were certainly the capitalization rates in the midst of the pandemic, and given the investor sentiments, I suggest very, very strongly would be no lower. If much more likely they'd be at least that high, and likely a little higher. In that context, we're suggesting the 6.75% certainly is appropriate for the subject. And for all of those reasons, we're requesting the reduction to a value of $1,750,000 this morning. And thank you for considering our submissions.
Okay, thank you for that. Mr. Pontanilla, questions?
No, just a comment. That was a good presentation. But I have no comments from.
Okay.
Thank you, Mr. Pontanilla.
I learned a lot there.
Carrie, any questions?
Just one question, just in regards to the building, Mr. Reimer. So this started out as a retail presence, correct?
I'm sorry, it started out as a
retail presence?
It's always been a retail, it's always been a Visions as far as I recall.
Right, but you had said they had customers coming in, and now
no, sorry, Ms. Linklater. No, I didn't mean to suggest it's changed.
Oh, I see.
It's always been a retail property, but the reason I believe that Mr. Pontanilla and the department is correct in characterizing it as a retail warehouse instead of there's this other categorization as a store. The store typically has got a very, very high level of retail finish, a high proportion of purely customer focused retail space, and a low proportion of storage. And the proportions here are very different because of the nature of the operations. Therefore, I believe it's properly categorized as retail warehouse. But yes, it has indeed been a retail property the whole time.
Okay. Thank you for that clarification. That's all my questions, Mr. Chair.
All right, Gail, any questions?
Thank you for your presentation. My question related to the vacancy. Now, did you say you're in agreement with the 4% vacancy loss that was applied by the assessment?
The 4% is consistent with the general retail indicators. So yeah, there's no reason to, it's a market vacancy. There's no reason to go higher than that in this case.
Okay. And the property, it's owner occupied, right? And it
Yes,
has
yes.
been from the onset, as you said.
Yes, yes.
Okay. Those are all my questions. Thanks very much.
Okay. On your expense study, the problem I always have is that the municipal board has very clearly stated that we can't include leasing commissions in the calculation of non-recoverables, albeit in the form of a direct reduction from rent, I believe it was. Have you ever done a calculation of the non-recoverables with leasing commissions removed?
What we said that's the very point, Mr. Chairman. And your question is a very good one. Actually, I'm glad you've raised it, and I know that you're very familiar with this, because within the question you've hit on exactly the very point that we've made in the past. What the municipal board said is repeatedly, and no question at our end, you can't take off TIs. What the applicants in those cases were doing is they were calculating a net effective rent by taking the TIs dollar for dollar off the potential net market income. And as you've identified already, we're not doing that. We are saying what the board never intended was to have the non-recoverable expense allowance not apply, because it is an erosion to the, not the end, it's not a calculation of an NER, it's an erosion to the actual face net rent that's being calculated. And so your second part of the question, have we calculated it using just the 1%? That's exactly the point in the updates that I provided to the board this morning, considering that scenario where the very same capitalization rate the capitalization rate indicators based on the very same set of assumptions using 5% or 1%, the mathematical change is about between 28 and 33 basis points. So what I'm suggesting, Mr. Chairman, which is exactly getting to your question, if we have calculated in our, as you would see in our retail study, that all of the materials towards the end of that study are attached showing the 5%, the 5% being included. If the board were inclined to agree, to go with the 1%, which is the assessor's submission, that's all fine. That's all well and good. But then, based on that scenario that I've given in our non-recoverable study, the capitalization rate for all of the comparables goes up by roughly 33 basis points. So it is there. I'm going to actually go back to the one page. Let me get to that correct page in the retail cap study. So if you go, Mr. Chairman, back to now I'm referring back to the retail capitalization rate study. So if you go to page 24 of that study, please.
Okay.
So there's two columns there. The first column, it says, the Altus cap with the asterisk. So that's with the full-on 5% included in every case. And then there's the adjusted cap. And these are the very equivalent, these are the exact same, and again, you can appreciate it. So the exact same parameters, sale price, the rent income, everything else, except reducing the 5% to 1%. And then the indicated cap rates using just that single change are shown on the last column. So
I'm not so much worried about that. I would like, on your page 11, I would like to see a third column there of non-recoverables with no TI and no leasing commissions, and see what the average there.
Oh yeah, and we have not done that, Mr. Chairman, with greatest respect, and I understand fully where your question's coming from. And quite bluntly, it's going to have to be and will be debated at the municipal board. that gets away from the very crux of the argument. And I'm not, while I understand the question, I'm not sure we would consider that change at this time until we have further confirmation from the municipal board that if they're still disagreeing with our methodology, despite the evidence we're presenting, that would change our whole approach. But I do understand the question.
Yeah, okay. All right. Thank you very much for that. Is there any submission you wish to do, Mr. Pontanilla?
No, I'm okay.
Okay, any summation?
No,
Jerry?
thank you.
All right,
thank you.
thank you for that. Then we'll move on
Okay.
to the next property on today's agenda, which is 1161 Pimna. I understand there's a different representative here, so can you?
I think I'm, Mr. Chairman, can you confirm that I'm done? Then I'm going to leave. I think
Yes.
that was my only one.
That
All
was
right.
the only property we have on today's docket remaining.
Perfect.
Yes.
All right, thank you all. Thank you, Mr. Pontanilla. Have a good day.
Have a good day.
Bye-bye.
Okay. Okay, so next property is 1161 Henderson, and Belen, can you swear in the applicant?
Yeah, I'm just waiting.
Hello,
Oh, there you are. Mr. Applicant, please state your full name,
Lyle Rack.
and you affirm the evidence you're about to present is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
All right. So on 1161 Henderson Highway, Mr. Pontanilla, you can begin.
Okay, and I just want to mention that I have had some contact with Mr. Rack, so we do have a couple joint recommendations that we're making. So this would be one of the first recommendations that we're going to be making, and I'll begin with the presentation now. The
Okay.
file number is 22-3761. The roll number is 0400-001-9000. The address is 1161 Henderson Highway. The 2023 assessment has gone out initially at $644,000. And I do have a recommendation to make on the file.
All right, go ahead.
If I can turn your attention to page 8 of my brief, and I'll give you a second to get there.
All right.
So originally on this subject, we had 3 premises associated with the income stream. And this is also under retail. So we are speaking of a retail property now from the last, deviating from the last presentation. So we have 1,202 square feet at $16.66 per square foot. We have 800 square feet at $17.13 per square foot. And we have 1,040 square feet at $16.82 per square foot, which gives us a total potential rent of $51,222. And we have then applied model parameters of 6% vacancy, a 3% expense rate, and a $7 per square foot shortfall rate to give us a net operating income of $45,427. We've then applied a cap rate of 7.05% to bring us to our initial assessment of $644,000. And so for the recommendation, we have tampered the rental rates on the 3 premises to bring the rental rates slightly more down and in line with what seems a little more reasonable for the property. So we now have 1,202 square feet at $15.72 a square foot.
1572, you said?
Yep.
Okay.
And then we have 800 square feet at $16.21 a square foot.
Okay.
And then we have 1,040 square feet at $15.89 a square foot.
Okay.
And so that gives us a new total potential rent of $48,389.
What was it? How much was that?
$48,389 for a total potential rent.
48,389. Okay.
And then we have the model parameters of a 6% vacancy, a $7 shortfall, and a 3% expense rate to give us a revised net operating income of $42,843. 42843.
42843.
Yeah. And then we've slightly increased the cap rate from 7.05% that was model driven to 7.25%.
7.25.
And a little more appropriate for the subject that we're speaking of. And then the final value is $591,000. 591.
591,000. Okay, and Mr. Rack, are you in agreement with that?
Yes, I am.
All right. Are there any questions from the panel on this? Carrie, any questions?
Just one question, Mr. Pontania, did you make these adjustments based on the age of the building or based on an inspection or comparables?
So mine was a combination of comparables along with a look at the subject's history itself. So its past history, its current financial performance. And all those indicators led me to believe that the model had come in this cycle slightly aggressive on the subject property and that a little bit of a tampering was needed.
Okay, all right, I thank you. That's all my questions, Mr. Chair.
Okay. Gail, any questions?
No, my questions have been answered. Thank you.
All right. And I have no questions, but let me just enter everything into my spreadsheet here. So I got the rate numbers. Okay. Thank you for that. Then we shall move on. 441 Main Street. Let me pull up the files. Oops. Okay, on 441 Main Street, you can proceed. Mr. Pontney, you can proceed on.
Yeah, I'm just getting my paperwork in order here.
Okay.
Okay, so just like the last file, we have been in discussions and have a joint agreement. So I'll just begin with my presentation and then we'll go from there. So
Okay.
the file number is 22-404. The roll number is 1306-277-5000. The address is 441 Main Street. The 2023 assessment had gone out at $968,000. And as I mentioned, I do have a recommendation to make on the file.
Okay.
So this one is going to be a little more complex to describe the recommendation that was made. The reason being is that this file has an extensive history of in the past that it has been reviewed. And I did work on this file in conjunction with a colleague of mine in particular who has done a lot of previous work on this particular file. And so originally, if you look at our page 10, our income stream actually shows a total. I think we have, I'm counting around 17 premises associated. I might be off by one or so, but we have around 17 premises associated with the income stream, equaling a total of 16,018 square feet. The models then applied, if we add up all the rents, we have a total rent of $112,590. From there, we do have a vacancy that has been carried forward due to the issue that the subject is having retaining tenants. There was a previous vacancy that was put in place of 15%. So it was to account for the issues that the subject is having with vacancy. We do have a 3% expense rate, a $7 shortfall per square foot rate, which gives us a net operating income of $76,011. And then we have a modeled cap rate of 7.85% to bring us to our value of $968,000. So with that being said, it is my understanding, working with my colleague, that the area that we have on file is off from what the actual area that's being used for the subject right now. My colleague is in agreement with Mr. Rack's brief, as well as the income and expense mailer, which shows a revised area. So for me to give you the recommendation, it's a little difficult because I can't go line by line through all the premises, as we have some of the premises, from my understanding, were amalgamated. Another premise was removed entirely from the income stream. So it varies from what you see that was presented in front of you. So I believe the best way to do this would be to just give you the total area that we have now, which is in line with the 2020 income and expense mailer.
Okay.
The total area that we're now using is 9,175 square feet.
Okay.
So that's the revised area that was agreed upon by my colleague and Mr. Rack when they had a review on it. I believe it's 9,175 square feet. And then the total potential rent that we have on that is $85,387.
85,387.
Yep. So then you can get the revised rate overall that we have of $9.31 per square foot on the property.
931.
Yeah. As well, when I was doing a review of the property to get ready to come to the hearing, I did do a vacancy analysis on the property. So I took the total vacancy and then I applied the department's documents on how to come up with an appropriate vacancy for the subject. And it appears now with the vacancy that the subject is going under, that a more appropriate rate of 20% is now allowable for this subject property. So we have a revised leasable area. We also have a revised vacancy that now goes from 15 to 20%. And that is to accommodate for the current vacancy as of the economic reference period that the subject was dealing with. We do have the standard $7 shortfall rate, the 3% expense rate, which brings us to a revised net operating income of $53,415. So 53415.
Mm-hmm.
And then as well, it was deemed with the review that the cap rate could also be altered due to the subject's performance, its issues with tenancy, its issues with its interior layouts. There were several issues with the property that led us to believe that a characteristic adjustment was warranted. So we adjusted a characteristic, and the model now has an 8.5% cap rate that's applied to the subject.
Okay, 8.5.
And so the revised value that we're offering now, and which I believe Mr. Rack has agreed upon, is $628,000, 628.
Okay, are you in agreement with that, Lyle?
Yes, I am.
All right, thank you for that. Now, from your comments, and I understand the next two properties are going to be subject for debate. Is that correct?
Yes, that's the case. So for the next two properties, we couldn't come to an agreement on value. So I'll just present my files and then he can present his.
Okay, let's have a 5-minute break now then, and then we'll get into the final two properties.
Okay, so we're okay with this one? I can close this one off?
Yes.
Okay. Thank you.
Excuse me, let me just say, are there any questions from the panel on these properties?
I have no questions, Mr. Chair. Thank you.
Gail?
I have no questions. Thank you.
All right, thank you. Then we'll have a 5-minute break. Thank you.
Okay.
All right, thank you. We'll come back to 957 Portage Avenue. So, Mr. Pontney, you can commence.
You are muted. We can't hear you.
Sorry, I saw those those words come up there, alerting me to that. So the next file we have on the docket is file 22-3742. The roll number is 1302-201-9000. The address is 957 Portage Avenue. The 2023 assessment has gone out at $864,000. This building has a 1980 effective year on it. The leasable area is 5,635 square feet. And looks like there's a basement as well of 1,155 square feet associated. So if we look at page 2, you can see my pad eye view presentation of the subject property. And we can see its orientation alongside Portage Avenue. On page 3, I have an overhead pictometry view of the subject property, where we can see it's on the corner of Portage Avenue and Lipton Street. I believe it's in the West End area there. On page 4, we have a south-facing view of the subject property and an east-facing view of the subject property. And then on page 5, we have some Google Street View images of the subject property. So as we're approaching, face on, and then as we're departing. And we have received requests for income information from the subject property, so we're okay there. And we do have 2 sales on the subject property, one in December 2000 for $475,000, and the most recent from September 2nd, 2011 for $640,000. And we have no property lease information on the subject property. For my comparables, I have included as many comparables as I could within that were as close to the subject as possible. So we do have some variation in rent rates going from, it looks to be around $12 at the lower end. And then we have going up as high as $19.46 at the higher end. And then if we look at the subject's income stream, we do have one premise associated at 5,635 square feet. And the modeled rental rate applied is $13.07 per square foot. We do have a 6% vacancy in place, a 3% expense rate in place, and a $7 shortfall per square foot in place, which brings us to a net operating income of $64,786. And then we have a modeled cap rate of 7.5% to give us a assessed value of $864,000.
Okay, questions, Mr. Reck?
I have no questions.
Okay, Carrie, questions?
Did you have a chance to inspect this property, Mr. Pontanilla?
Well, I actually, I live in Westwood in that part of the city, so I do go by it daily on my commutes to the office and back. So I haven't done a drive-by inspection, if you want to call it that. But besides that, I haven't inspected the interior. I did visit the interior of the property in 2020 for an unrelated matter, but related to the department work. So I was there a couple years ago, so I am sort of familiar with the subject, but I haven't inspected it for this particular cycle.
Okay. Do you have any notes on when it was last inspected?
Well, I mean, I went there myself in 2020, and I believe I went there with a colleague of mine who was working on this file at the time, and we did some work together, and I'm not sure if anyone has gone since. All right.
Can you speak to the condition of the property then?
I thought the condition was good. It was, it was an average retail finish. It had, it's used as a photo camera retail store. So they had, from what I remember, they had like some glass areas where they had some products that were displayed, and they had some more products on the wall, all associated with photography and whatnot. And it seemed, like it was a when I characterize it as good, I don't want to mean to say that it's like above average. Like it seems like an average retail, but it seemed like a nicely finished area. Like it was a typical retail finish, let's say.
All right. I thank you. That's all my questions.
All right, thank you. Gail, any questions?
In regards to the sale that you mentioned, 2011 sale, that was an open market sale, both those sales that are noted in the, yeah. Were there any building permits after the sale that are on record?
You know what, I did look at that. If you just give me 1 second, I can just bring up something here to let you know right away for my permit research that I did. No, there was no permits of value that were in either folders that I usually check where they put that sort of information. I didn't find any permits of value. So for our records, no extra capital has been put into the building in any way. So. Okay.
And yeah, you said this is a Photoshop. So is it owner occupied? It's not? You can't determine that.
The thing is that it is, so we look at the mailer here. I I think from when I did my research on it, like that section of the mailer was left blank. So if you look at page, sorry, we can do it together on, I was looking at
Yeah.
the document there. If we look at page, I guess it would be page 16, and I apologize, you might have to turn your head like that or flip it if you want on your screen.
Yeah.
But it doesn't actually indicate whether it's owner occupied or not. You can see that it was left blank. And we
Right.
do have a rental rate in place. So I did do a rental rate analysis based on just the information we had. But then when we look at the tenant verification form, it does look like they do indicate that the services are included in the rent, which would then lead me to believe that it is a gross rate, although they did check off net lease as well. So they checked all the boxes off. So sometimes it's a little hard to exactly get how the lease is set up, but that led me to believe that it was a gross lease in place. So are they table rents? Are they declared, are they, other forms of rent that's being declared? I'm not sure. I can't speak to that.
Okay, and the cap rate, that is model generated, right? Like,
It's just all
yeah.
model generated. And I felt like it was okay for the subject at 7.5%.
Yeah, it's built in 1949.
1949, but we have an effective age of 1980, I believe, on it. So at some point, there was a review that was done, or the work was deemed that it required a newer effective age. But yeah, it was built, I believe, in 1949.
Okay, thank you very much. Those are all my questions.
You're welcome.
Okay, and I have no questions. Carrie, did I check with you if you had questions? Say, I got a good memory,
You
just
did,
short.
thank you.
Okay, all right. So, Mr. Rack, you can begin your presentation then.
Thank you. I just have to say that it's not owner occupied. That's actually a market lease. So if you go through page 1, you'll see it went up 29%. You go to page 3, the assessor's correct. It is a gross rent. You can see that the net operating income for 2020 was $53,164. If you go to page 4, you'll see my comparables. Most of them are all on Portage except 2 on Roblin. Number 4 and 5, which are quite a ways out. Roblin, which would be comparable to distance to the Portage Avenue location. But you can see that I have an awful lot of Portage Avenue rents. I have the actual rents on the bottom there for 2626 Portage, 957 Portage, and 3096 Portage. I represent all those buildings, so I know that those are the actual rents they're receiving. I have 2 assessor comparables at $10 and $9. So you can see there's a big range, going from $675 up to a top of about $1060. But you can see there's 5 in the $1060 range. So and basically there's some of the $9. So basically $9 to $10 with an average of $932. So the question here I'm looking at is that whether or not the actual rents are indicative of market. So you can see it from those averages, we get $932 square foot. So they are gross rents, page 4 there. So you'll see I've listed 3 net operating incomes for the building from 2018 to 2020. And the best one is 2018, because expenses vary a little bit year to year. So 2020, the net operating income was $52,164. So if you go to page 5, I bumped that up. I just rounded it up to $55,000 using $976 a square foot and applying the city's parameters. I'm getting a value of $637,000. I think at $976, my comparables prove that basically that is a market rent down Portage Avenue. And at the bottom, you'll see that there's 2 additional comparables from the assessor's brief back in 2019. One is a 10-year lease at $9, so that one's a little out, but 1375 Portage is at $10. So based on my comparables and the actual gross rents and bumping it up to $55,000, I believe that to be a market rent, and I'm looking for the board to reduce to $637,000. That's my presentation.
Okay, questions, Mr. Pontonia?
No, I'm okay with questions, thanks.
All right, Carrie, questions. I'll make sure I'll check you off this time.
I have no questions. Thank you, Mr. Chair.
Oh, that's disappointing. Gail, any questions?
Just in regards to your document, your presentation on page 4, where you note the NOI, the 2020 NOI of 52,164. Were you meaning that was the potential rent? And maybe got lost there. You indicated 55,000.
That's correct.
Okay. Okay, so that should say potential rent?
Yes.
Okay, thank you. Those are all my questions.
All right, and I have no questions, so thank you for that. We'll go and come on to the last property, 120 Higgins Street. Again, that
Mr. Chairman, I do have, sorry to interrupt, but I do have a rebuttal for that brief.
for Higgins?
No, for 957 Portage.
Oh, okay. Let's see the rebuttal, and I didn't say it wasn't. Do we have it, Belen?
Yeah,
Oh,
it's
yes,
already in your folder.
about a minute ago. Okay. I'll just go back. Okay. Go ahead on your rebuttal then.
Okay, so you'll see page 1, there's 13 comparables that the assessor has used. If you go to page, the first comparable as you scroll down is actually at 770 Notre Dame, but that's not on Portage Avenue. It's actually quite far away from the subject. It's opposite nursing residence, and actually it's the nurses union. I was in this building about 5 years ago. It's an extremely nicely renovated space, and it's far from the subject. It has all glass partitions in it that are etched partitions. So that's a very nice location. It's an office. And again, it's at 770 Notre Dame. So it's by the Health Science Center. So that's really not in close proximity to the subject. You look at comparable number 2 is 625 Sargent. That used to be Crown Grocery. They did not renew the lease. And if you look at the pictures of it, it's actually an old bank building. And if you'll see, if you continue down to page 5, you'll see the back there where there used to be a drive-through to the instant teller. And you can see the extreme amount of paving. So that property would have a lot of parking on it. And that would demand a higher rent with all the parking. The subject property has no parking at all, and they have to deal with rush hour where you can't park on the street. So if you continue down, you'll see that the building is for rent. If you go to the next comparable of 1011 Portage, 110 Portage, Boers Paint. Yeah, that's a comparable property. It is on Portage at 1643. That's basically the only comparable. If you go down to the next, you'll see that the assessor comparable 4, 5, 6, 7, 8, 9, and 10 are all in the same strip mall. So the strip mall basically has frontage parking that you can just pull up and park, and that would demand a higher rent. And being in a strip mall, always you're going to pay a little more rent for being in a strip mall. And maybe a slightly nicer building, but kind of similar. But it's the parking up front that you can just drive up and park. So again, you don't have to deal with rush hour traffic where there's no parking on the street, and that would demand a higher rent. And then the 1054 Portage is still in that same mall. And if you continue on down, 1060 Portage is in that mall also at 1250. And again, that's the parking and the signage for advertising. That was a tanning studio, and I'm just guessing it was closed because of the pandemic, and that's in the same mall. So there are 8 units in this mall, and it's 2021. Looking by the picture and doing some research, there's actually 5 units are vacant. I'm thinking that basically if those were re-rented in 2021 with 5 being vacant, I'm sure the landlord would not get the same type of rent. And so basically the assessor only has, I think, one comparable on Portage Avenue, which I think to defend and prove the model, more rents would be required. And as you see by my brief, I had lots of rents on Portage Avenue. So there are rents on Portage Avenue that one could use. And that's my rebuttal, Mr. Chairman.
Okay, questions on the rebuttal, Mr. Pontonia?
Well, do I have a chance to rebut the rebuttal, or do I have to give him some questions first?
Well, questions first, and then if you have some rebuttal to the rebuttal, then we'll do it then.
This kind of was sprung on me here, so I didn't really have a chance to prepare for any rebuttal information as I was just given it now. You know, I have no real questions for Lyle. You know, I mean, he's done his presentation. I didn't, due to the volume of appeals I'm working with, I didn't have a chance. I didn't know he was going to have a rebuttal. I didn't have a chance to necessarily look at his comps, because I can honestly say that I did take a look in the neighborhood and I couldn't find very many that were even comparable and had the same use that I could look to as actual net rents. So we run into this issue sometimes where we have, do we give comps that are within the neighborhood but might not necessarily be the best fit? And then of course the rental rates will be shown accordingly. Or do I give you a bunch of comparables from within a market region, which might have a lot more neighborhoods involved or a lot more neighborhood clusters involved, but that might not necessarily be across the street. So we always run into this issue with finding appropriate comparables for a subject property. I would say in the end, it's lease information. So does one have 10 parking lots and one has 15 and one has 2 and one has 4 and one walks in the east and one walks in the north? Yeah, sure, there's gonna have variations on a lot of different properties, but in the end, it's lease information. That's what we're looking for. We're looking for market data indicators. And I would say that for all of the rebuttal information to try to show that my comparables weren't appropriate for the subject, we're talking about a $13 per square foot rental rate. So in the end, you know, if those are of higher quality, they're reflected in the rental rates. This is a $13.07 per square foot rental rate. So I wouldn't consider ours to be without the realm of being, and especially from my inspection in 2020, it wouldn't be out of the realm of a reasonable rental rate. And that's my rebuttal.
Okay, Carrie, any questions on either rebuttal?
I have no questions of either. Thank you, Mr. Chair.
Okay, Gail, any questions?
No, I have no questions, Mr. Chair.
All right, thank you. Now we'll move on to our last property, 120 Higgins.
All right.
Okay, let me just pull up the file. Okay, you can begin now, Mr. Pontonia.
Okay, so next on the docket, we have file 22-3720. The roll number is 1309-604-6900. The 2023 assessed value has gone out at $647,000. This is labeled as a commercial retail store. We do have an actual year built of 1912 and 1963, along with the effective year built of 1912 and 1963. And we do have a total leasable area on the property of 12,287 square feet. So on page 2, I have provided a pad eye view image of the subject property. So we can see its orientation is on the corner of Higgins and Waterfront. And then on page 3, I have provided an overhead view of the subject property. On page 4, I've provided both a north-facing view and a west-facing view of the subject property. And then on page 5, I have included a Google Street View image of the subject property. And it does show the approach, face on, and departing. On page 6, we do have some information in regards to the request for income information, which we have received, so we're okay there. And then we do have one sale from 2009 for $410,000. And I believe this subject is owner occupied and we have no subject property lease information on it. The rent comparables were very difficult to locate for this subject as there's almost no net leases around in the neighborhood that we could look for. So I worked on this in conjunction with a colleague and we did find some comparable rental rates that were seemed to be somewhat appropriate for the subject, but this is a very difficult subject to find actual appropriate comparables. And we do have a range there from $3.75 at the lower end to $8.16 at the higher end. And then for the subject itself, we do have it labeled as a C2 standard finish retail income stream. We do have 12,287 square feet on file at $6.06 per square foot model driven. We do have model parameters of 6% vacancy, a 3% expense, and a $7 shortfall for a net operating income of $62,730. We've then applied a cap rate of 9.70% on the subject to come up with an overall assessed value of $647,000. And then on page 9, we have our income value summary of the income stream that we just spoke about. On page 10, we have our cap rate study information. Page 11, our Municipal Assessment Act excerpts information that we have. And then on page 12, and taking us to the end of my brief, is the subject's 2020 income and expense mailer. And that's my presentation.
Okay. Questions, Mr. Rick?
Yes. If you look at, could you turn to your page 1? So we have an effective year or actual year built an effective year, 1912 to 1963. Since there's no effective year adjustment, would you agree that that building no money has been put into to renovate that building and it's basically in its original condition?
I would agree to that. Yep, I did do a review of the subject's history, and it looks like it is it has been in a somewhat aged state, we can say. But I do agree to that.
Okay. So if you look at page 5 of the exterior of the building, you agree that the exterior of the building is in bad condition and would probably need some capital investment to renovate the front of the building?
I would agree to that.
Okay, can you turn to page 7, your comparables? And in your opinion, which one of those comparables would you think is closest to the subject in quality and condition?
You know what, it's unclear. I mean, these comparables were drawn from a pool of what was available, and it's really difficult to rest my hat on one. You know, I would say, and you know, some of these I did do another look and I did do a slight adjustment because I did another review of these comparables as well. So some of these rates might be slightly off. Like for example, 675 Washington Avenue, I had it at $3.75, where it's actually at $4.27 a square foot now. 771 Main Street, I had calculated $5.17. Another review showed it at $4.66. So they're all within the range of themselves, but slightly different. But you know, it was very difficult for me to come up with any sort of good comparables. I had a really hard time even finding these. We have a $6 square foot rental rate on it now. You know, if the information shows that it needs a slight adjustment on the rental rate, I'm not in dispute of that.
So you're saying that 771 Main Street was actually $4 and how much?
$4.66, so slightly less from the $5.17 I put there.
Okay. And I guess the last question would be, on page 15, there's been significant impact on that property due to COVID, correct?
Yep, I did see that. I saw
owner.
that they had declared that.
Okay. Those are all my questions.
All right, Gail, any questions?
Yeah, just in regards to the vacancy rate of 6% has been applied. Do you think that is Again, do you think that that reflects the location and condition of the building accurately?
Well, vacancy is an overall rate that we apply based on property types. So this being a commercial retail store, it's sort of a market vacancy, it's an average. So all buildings have a vacancy in place, even if they are vacant or not. It's just a modeled vacancy rate that's part of the income stream. And I mean, if we're talking about vacancy in particular, referring to the actual unit itself being vacant, from my understanding, it's an owner occupied space and he's been there since he's purchased it. So there has been no vacancy requirements needing any sort of adjusting on the income stream.
Okay. Okay, and the cap rate of 9.7%, is that kind of the high limit of where the city would apply a cap rate in regards to this age of a building?
I mean, it's definitely up there. Like it's not very often you see cap rates that are model driven at starting, or, you know, applied at 9.7%. So I would say some of the questions that Mr. Lau had brought up in regards to its current use and its current condition, I think when I did a review, it's reflected in the 9.7% cap rate. That's a high cap rate. You know, if it had $500,000 in renovations inside and outside, would it reduce the cap rate? Probably. And so I feel like that 9.7% to me seemed very reasonable for the subject property.
Okay, those are all my questions. And were you in the building? Sorry, that was my other question. Did you inspect?
Again, this one actually was in 2020. I had inspected both the previous file that we spoke about and coincidentally this one as well. So I have been in there back then. I went and did an inspection with a colleague who had been assigned this file at the time, and I was kind of just learning some things, and we went together to inspect it, but I haven't been there since. But I don't disagree with what Mr. Rack says. It didn't seem like it was then, and if you look at some of the subjects, his pictures, that it does show that it's in a bit of a let's say a depreciated state, I guess you could say.
Okay, thank you very much. Those are all my questions.
You're welcome.
Okay, Carrie, any questions?
I just have one quick question of Mr. Pontinia. It's you on the front of your brief, it's a 1912 with an effective of 1963. Is that age model driven?
They're both model driven, and they both would have been due to their, from my understanding, there was an addition that was built on the subject at some point in the 60s or in 63. So that's why we're showing two actual year builds. We have, I believe it's the original building itself was 1912. And from my understanding, there was an addition that was built in 1963.
Okay.
But again, I would say that, yeah, it's absolutely shown in the rental rates. I mean, this is a modeled rental rate of $6 a square foot. It's pretty low as it is. But I'm not saying that's the right one either. I mean, perhaps it does need a shading on the rental rate as well. I'll leave that up to your guys' capable hands to decide, but it was difficult. It's difficult to value this one because of its unique challenges that it faces.
Yes. So the model gives the year of 1963 based on a renovation that took place or an addition, correct?
An addition, yeah, it was an addition. So there was two.
Okay, and so it does not take into consideration the current. Is it so? Do you have to adjust the age manually yourself if you were going to do that in regards to the age of the building, correct?
That's correct, yeah.
All right. Thank you, Mr. Pontinia. That's all my questions, Mr. Chair.
Okay, I have a question regarding the oldest part of the building. The part that was built in 1912. Back then, it probably would have been knob and tube wiring. Do you know if that has ever been improved or anything like that? Has been brought up to modern standard, or do you not know?
That's a great question, and I know I can't answer that myself. I would love to know. That's actually a great question. I'd be curious myself to know if, and maybe Mr. Lau can, or Mr. Rack can illuminate us on that, but I'm not aware of that myself.
Okay, thank you. Then Mr. Rack, you can give your presentation and hope for illumination.
Thank you very much, Mr. Chairman. So page one, you can see the exterior of the building, and the outside does need repair. The wood at the bottom, you can see it's kind of dark. The wood is actually rotting. and the top piece there, the blue, dark blue, is actually metal, and that's actually rusting out. And you'll see next door that the neighbor is actually the King's Hotel. You look in the bottom picture, it's by Disraeli Freeway, so it's not the best, the neighbor's not the best neighbor you could have. Location is not the best you can have. I mean, it isn't a bad location. If you look down at the chart underneath the picture of the bridge, you'll see there's 3 building sections. The original was built in 1912. That's all original. All these are original. Then the next section was built in 1941, 8,000 square feet. And then there's a small piece in 63 of 1,050 square feet, and that's actually like a loading area. And I'll show you where that is in a picture to come. So the pictures shown here are the 1912 building. So you can see a picture of the ceiling. It does have some problems with some leakage. You can see that the ceiling is actually planking, and then it's been it's had some board put over top of it. It actually, on this side of the building, it actually has the old stamped, I guess they would be copper tiles, but some of them come down, but it's in pretty bad shape. If you look at the bottom, in the 1912 building, that's the floor in that side of the building. You can see the tiles are actually worn out, and some of them are missing, and you can see that the floor is actually wood planking. So all the tiles on that part of the floor have come off, and the floor is actually wood planking. So that is basically original from 1912. Go to page 3. You'll see there's some pictures of the inside. The top picture there is the 1912 building. It has just basic fluorescent lighting, no diffusers, and you'll see in the middle of the picture, it's heated by an industrial heater that's hanging from the ceiling. So this building has no HVAC system in it. It was originally a warehouse, and it's still basically an old warehouse that's now being used for retail. You'll see parts of the store just below. Again, ceiling's all planked and ceiling. Fluorescent lights, there's no diffusers, and on the bottom middle picture, you'll see on that part of the store, there's a gas heater hanging from the ceiling. So again, it has no HVAC system. It's like an old warehouse. So if you look at the picture of the aerial view, where it's got that orange symbol that indicates the property, that's the 1940 building. The little section to the right of that on the highway is the 1912 building. And then right underneath the name where there's some cars parked, there's a little tiny piece there. That's a piece that was added on for, it's not heated, and it's just basically a little loading area that you can actually, there's like a garage door there that you can bring in a product. So we talked about below that to the next page, page 4, I talked about the exterior, and you can see how bad the exterior is. There is only 2 windows by the entrance. That's it. And again, you'll see the hotel next door, which, basically doesn't have the best clientele hanging out. So there's not a very good neighbor there. I go to frequent the store quite often because I'm into hobbies, and I always have to look over my shoulder when I'm going into that store. So if you go down to the next page, page 5, you'll see the property has gone up 86%, and that's all model driven. So basically the model is basically bumped it up 86%, which I think is ridiculous. But anyways, that's the model. So you go to page 6, you'll see that the department has used $6.06 a square foot. I have some comparables here, and these are assessor comparables from 2023, appeal on another property. So you'll see these are all in the $3. The lowest one is $3.67, and it goes up to $4.83. So these are all assessor comparables, same types of property. And you'll go on the bottom there. There's one at Adelaide, which is by City Hall at $4.06. So that one is a better location. It's opposite Red River Community College. So these are some pictures of those comparables. So The comparable one at 4,840 square foot is at $4.96. That's pretty well looks like the building. The subject property is in better condition. It has an overhead door in the front, and you can see it's got out front parking. So that out front parking would basically, obviously, increase rent in a building like that. If you go down to the next picture, you'll see this is on Ellis. So that's a better location, same as the one above is a better location. That's 6,042 square feet, and that's at $3.90. And if you look to the left there, so there's some chain link fence in the corner. It has parking also. It's quite a large lot. It goes right across the front of the other side of the building. You go down to the Aaron property, number 3. Much superior building, although it's 2 stories. It's a much superior building at $4.83. Go to the next comparable on Coulter Avenue. That's at $4.53. Similar to the subject property. Got a overhead door similar to the subject property. Ceiling height is about the same. Better condition, newer building, and that's at $4.53. You go to the next comparable on Aaron. That's not comparable to the property, but it was basically on that comparables for the assessor sheet, so I put it in there so you can see what it is. That's at $3.67. So $3.67 for that fancy building. And if you go down to the next on Barry, 64,840 square feet at $4.17. That's a superior building. Lots of office space in the front. That's at $4.17. So go back page 10, then go down to page 11 where the valuation is. So I've got all these there, and basically you're getting about $4.30 square foot average. There's another comparable in Edwin that's 2 blocks away. That was built in 1948, and that's renting for $4 a square foot. 92 Gomez is across the street, just down the side streets. It's a 3-story building, and the main floor is renting at $392. So I'm looking at, due to the location and the condition of the building, I'm looking at $4 a square foot. So I'm getting up to, using the city's parameters, $4 a square foot, I'm getting a value of $409. So 2019, this property was reduced to $307 by the Board of Revision. I signed a certificate of agreement with the municipal board. The owner didn't want to take it to the municipal boards for $340,000. In 2020, the board reduced it to $348,000, and the city did not appeal that. So I think at $4, based on the condition of the property, is not a very good condition, and due to the location beside the hotel and the Disraeli Freeway, and there's currently an outstanding lawsuit on that building because when they were building Disraeli Freeway, the entrance or the rise part of the freeway going onto the freeway, there were numerous piles that were driven into the ground. And when they're driving all those piles into the ground, it shook the building and actually did some structural damage to it. I don't have any information on that, but basically that's what happened. It's basically currently in litigation. So I think the $4 a square foot is acceptable for the property, again, for its location and condition. And I'm asking the board to reduce it to $409,000. That's my presentation.
Okay, questions, Mr. Pontanilla?
Sure, Mr. Chair. I thought we weren't supposed to bring up past assessments when we're doing our presentations.
No, you were correct. The board will put no weight on past assessments, as we don't know what evidence was presented to arrive at those assessments.
And since Mr. Rack did bring it up, I would like to ask him on page, we have, where is it here? Page 5 of his brief, where he does characterize the percent change as 86%, which is ridiculous in his characterization of it. But Mr. Rack, would you agree that you were aware that there was an appeal that was in place in 2020? And if so, that the appeal in place would have had the original value. And I believe I have it here. If you just give me 1 second.
We're not going to put any weight on previous assessed
It's
values,
important.
so
It's the characterization, $594,000. So if we look at our 2023 of 647 to $594,000, it barely budged. So this is a board decision. So I just wanted to throw that out there, and I'll leave it at that.
yeah, all right.
And I have no further questions for him.
Okay, Carrie, any questions of Mr. Reck?
I have no questions. Thank you, Mr. Chair.
All right, Gail, any questions?
I have no questions. Thank you.
All right, and I have no questions, so thank you very much for that.
I do have a rebuttal for this.
Oh, do you? Okay. All right, let's get on to your rebuttal then. Go ahead.
Okay, so page 1, you'll see these are the assessors comparables, and basically I want to go through them. So the big thing with the comparables is you have to get something that is similar to the subject property. So I want to go through, first of all, is comparable number 6 on my page 1. So that's 125 Higgins. So I want you just to scroll down, just leisurely scroll down to through the pictures, and basically at $8.16, you can see what you get for $8.16. So as you scroll through the pictures, that building is on the other side of the freeway from the subject property. So scroll down through those pictures and just take your time. And once you get to page 4 of 14, now you're going to see what the inside of the office looks like for $8.16. And I'm using 4 for the subject. And you can see that the inside of that building is beautiful. It actually has a water feature inside the building. So you're getting an ad here on as you're going down, you'll see that there's an ad for 125 Higgins for rent. That goes back to 2019, that was October. And at that time it was $695. So now it's $816. And you'll see in the ad there that it says trendy, very comfortable workspace with a water feature. So this is that building. See the lunch area. And as you scroll down, you'll see the Israeli bridge, and you can see the subject property and the hotel yellow behind it. You can drive into that building with your vehicles. And you can see the water feature. Like, that's a beautiful building. That's $8.16 just down the street. So now if you keep scrolling down past page 9, we're on page 10. You can see this is 771 Main, which the assessor says is actually $4.66. That building is not comparable. As you'll see the inside of it, you can actually, it's got a commercial type floor in it, so you can actually drive trucks inside. They're going to use pallets, so you can drive forklifts inside. So that is not comparable to the subject property. On page 11, you'll see pictures of the outside. It's on Main Street. If you go down to the next comparable, which is comparable 5 at $5.38, that's a newer building. That's Western Glove. It actually has a daycare inside of it. So it's got on-site parking for numerous cars. You can see the size of the parking lot when you're going through those pictures. That's a nice building. And that's renting for $5.38. The subject I'm looking for $4, so that's not unreasonable. Scroll down to page 15 and you'll see Tradesman Mechanical. And that's close to the subject property. I would say, even though it's 2 stories, it's kind of comparable. It's got lots of windows. I've been in there because I bought my air conditioning from them 2 years ago. It's got a nice display area on the main floor. Been renovated. You can see where it is on Main Street, so it's on a better location. You can scroll down to page 17. It shows 1309 Mountain at 633 a square foot. That's Freed International. I didn't say that right. That's a huge warehouse. And you can see there's on the bottom of page 17 there, you can see there's actually in the picture 6 drive-up loading docks for semi-trailers. A huge parking lot. There's a parking lot on the other side of it. That's not comparable. Now you go down and scroll down to 100 Higgins. That's actually, I represent that property. And the property to the left of it, that you can see the semi-trailers sitting there, that's 47 Gomez. I represent that property too. I'll be mentioning that in a few minutes. So that's actually a garage. It's listed as a service garage, and basically that's where they repair semi-trailers. So that's not comparable to subject property. You can see the Israeli bridge to your right on the top picture. So it's just down the street from the subject property. Now we scroll down page 19, 515 Waterfront. This is an industrial foam manufacturing. It's owner occupied, and that's a book rent. I know that because the next building towards us is actually 34 McDonald, which is owned by the same owner of the service garage. And he knows that owner. And actually about 4 years ago when I was inspecting that property, the owner was at the back of the building, and I gave him my card and we talked about his building, and basically he told me that it was owner occupied. And if you look at the rent at $635, you can tell it's owner occupied and it's a book rent, because when you're looking at the other comparables, I mean, like Western Glove is in the $5 range, and it's $5.38. I mean, would you really pay $6.38 a square foot to rent that old beat up building? I don't think so. You know, you keep going down and you see 1,000 Alexander. Well, those are probably 24-foot high ceilings in there. You can see that there's loading docks. You can back up to it. And it's actually a manufacturing place. It's called Bake Mark. It's a bakery. So that's a commercial manufacturing, not retail. And that building is not similar to the subject property at all. And I'd say that's not comparable. You keep going down, you'll see 675 Washington Avenue. That's an industrial building, manufacturing building again. You can see pictures of the inside. They make some kind of equipment. And if you scroll down to see the outside of the office, the huge building, and you can see it's got 3 overhead doors that you can actually drive vehicles inside of it. And that is not comparable to the subject property. And that's my presentation, Mr. Chairman. Thank you.
Okay, Mr. Pontanilla, questions on the rebuttal?
No, I'm okay on the questions. Thanks.
Okay, Carrie, any questions on the rebuttal?
I have no questions. Thank you, Mr. Chair.
All right, Gail, any questions?
No, I have no questions. Thank you.
All right, and I have no questions. So that concludes this property. We have heard all items on the docket today, and this hearing is now adjourned. Thank you very much.
Thank you.